It has come that time in which we will have our Trader Talk segment. Today's featured trader will be chart trader Brett Manning. Good morning.
Good morning, Jim.
So you were somewhat quiet earlier in the week, just a couple of trades, but you put one on the docket today in the mini NASDAQ. Not a huge winner, came back in, it's trading right around pretty close to your entry point. Why don't you walk us through what you saw going into that trade?
Sure. So, as you know, and as we've discussed quite a bit, I tend to break up the analysis that leads to a trade into two parts, one being the bias and the other being the setup. And at this point, we've got probably one of the most difficult configurations right now, and I captured that in my ETF daily notes this morning called overbought and underowned. And that combination is really tricky. The market has blasted off to the upside, and I would say that the primary catalyst for that is that the people who did not get shaken out in the December dive are unwilling to sell their portfolios. So it's a lack of sellers, and the market is floating up through a vacuum. There's a whole lot of people who did get shaken out. Sentiment data showed that. We've talked about that. But they are trying to rebuild their portfolio exposure now, and it's really tricky because they don't want to chase breakouts, and so there's a lot of competition on dips. That means the bias, even though the technical configuration, there's so many resistance levels up here, we're so overbought, but that means still the bias has to be to the upside because there's all this money that has been trapped out of the market. And I'm talking about, I talked about this the other day in my notes, you've got a number of different factor plays, the variable annuities, the risk parity funds, the quant funds. There's a lot of funds that are tied to the VIX. And we talked about them, I don't know if you remember last February, one of the better trades that I had last year was shorting for the implosion of the short VIX bubble. Mm-hmm. And when the VIX exploded higher, we had all these guys, the risk parity guys and the variable annuity guys and some of the quant funds, where their exposure is tied to the level of the VIX. They got blown out of their positions, and that's why we extended into that complete crash in February of last year. And we saw them rebuild, and we saw the same thing because they're tied to the VIX, but they're also tied to the volatility of the bond market, a lot of these guys. And so if you remember in October, it's one of the reasons I got bearish just off the highs is because of the breakout in interest rates, not because of the effect of interest rates on the economy, but simply because there's these, there's half a trillion dollars in risk parity related strategies that basically they're in a situation where the level of their exposure to either stocks or bonds is tied to a relationship with the volatility of the bond market and the stock market together. And when you see the VIX going up at the same time as you see, an explosion in rates like we saw, I think on October 2nd or 3rd, that was a clear signal that these guys were going to get chased out again. And so we saw all the volatility into early November. And now we're in a situation where they've been blown out and they're trying to get back in. The VIX is starting to dive, and so there's this chasing bid. The hedge funds, we've seen data suggesting that if you look at the portion of their returns, if you look at the HFRX benchmark, you can compare it with in a trailing 3-month beta with the SPX, and you can see the portion of the returns by hedge funds over the last month or so that's generated by the beta of the SPX is really minimal, and all the puts have stopped being bought. So either they're flat or they're short and hedging with calls on that flat position. So you can reason that hedge funds haven't warmed up to this rally yet. They've been fading it along the way. And yesterday morning I talked about some data out of Ameritrade, where they have a kind of proprietary measure where I think they do kind of an anonymous polling of accounts to get exposure, and exposure among retail investors is at the lowest level in like 6 years. So retail hasn't been buying this either. So you've got hedge funds, variable annuities, risk parity, quant funds, and retail all trapped out of this market, all looking to buy in a dip. And the thing that really sets it off is what we had last week, with probably the most Goldilocks jobs report you can imagine, and then a Fed 2 days earlier that did what Gavin and I called the have your cake and eat it too presentation of bias, and with icing and a cherry on top. Basically, the economy is really strong and we're not going to raise rates. So all of those factors together, if you're looking at all these people trapped out of this market, suddenly they really want to rebuild exposure. They don't want to chase breakouts, but they really want to rebuild exposure. So it's just really hard for this market to correct inside of that environment. And that means, for me, at this point, I feel like we could see an upward capitulation move to kind of these guys who don't want to chase and they want to buy dips. Eventually, I think they'll throw in the towel and chase. If they feel like, oh my gosh, this is just going to be a 3,000 on the S&P before there's a pullback and I need some exposure, especially the hedge fund guys. I've been in that situation. I know how it feels, you know, when you're sitting there looking at a market it's setting records as far as performance for the year and you don't have any exposure to it. And you're thinking, oh man, we're going to lose about half of our assets under management by mid-year. So these guys have a lot of pressure to show that they are participating in what the primary direction of the market is. So I think that we can see a kind of capitulatory blow-off to this rally from here. It's possible. Doesn't mean it has to happen, but we're trapped up against all these levels. We've got the 200-day moving averages coming in. We've got all sorts of stuff coming in. So we may be seeing some of the people who held on kind of feeling like the heat of all the gains they're sitting on without turning any of it into cash. We may be seeing enough to chop this thing into consolidation. But I feel like there's that squeeze waiting around the corner. So that long was basically... The setups are right now, you see a sharp dip, you know you're going to suck in a lot of shorts because that's the mentality. This market has gone up too far too fast. You know, there's a lot of people that are going to move in and short the first time they see anything like downside because this is finally it. You know, the humidity has run up forever and now we're finally going to get some rain. So when you see that and then you see a strong bounce come off those lows, then again it's that everybody who didn't buy into that dip starts to panic because they don't want to get caught in that blow-off move. They want to get in ahead of it. So I think that you've got the ability to kind of bake in these ranges midday and then break out to the upside again and really kind of turn the heat up on these guys trapped out of the market. So, you know, that's the bias building side of it. And then the setup is just a higher low back at a level, especially on the EU close. We had a lot of stuff back and forth. We can talk about, let's come back to the EU and Brexit. But, you know, when you're coming into the close for EU trading, when you've started to see this rhetoric getting slung back and forth to start the process of the more tough talk side of the negotiations there, you're going to get closes like that. And that offered me the shakeout down to 7,000. You know, it just turned out to be too choppy to keep me with that one. But maybe we'll get a sideways range that looks like it's going to leak up into that squeeze this afternoon. So that was basically the setup.
All right,
so there's the bias in the setup.
Go ahead. So the setup... You got basically ticked out. It dropped below 69.90, but you know, net it really wasn't far from your stop, and it's not too far away from where we are right now. So the initial trade, so here we are trading. I'm talking the mini Nasdaqs, right around the 70.06 area. Would you be inclined to throw that one on again?
So I want to see a midday consolidation, a sideways range that sets up a level to break. I want to see in the setup a bull trigger level. It's got to establish that. We know we've got that supply coming in, you know, basically selling into, if you look at the major components, you look at Apple around that 175 to 175.50 area. See weakness in a lot of the FANG stocks this morning. Obviously the semis have been really kind of leading. But if we see that offer just hanging in there, just kind of trying to trap this market along, box it in, if it goes without me, it goes without me. But if we see that come in and, you know, maybe actually shifting from the NASDAQ over to the S&P as far as the quality of the setup, but I want to see 2 or 3 touches on a level and then a pullback inside of it, kind of like a flag pattern off of this morning's low. But that's got to establish itself with a few stripes on that flag. So we really get a bull trigger level for all the people who've been doubting this market can extend yet again and who are lining up trying to short into every one of these things because they're about to catch the inevitable big pullback, which was, you know, it's reasonable, it may happen, but that type of energy sitting there along those highs sets that level up, hopefully a downward sloped level but shallow across a number of different highs, maybe through the next hour or two, and then toward the mid-afternoon to late afternoon we start to break above it and we cascade out. The shorts just get kicked out and we get to new highs, and then we start to turn the heat up again on all this money that's been sidelined and has been trying to rationalize waiting for a dip that gets harder and harder to rationalize as they still show no exposure and this market just continues to run away from them, eventually those emotional decisions get made, and that's how you capitulate something. It's just like the downside that we saw into Christmas Eve, right? I mean, there are people who didn't want to sell, but eventually they're sitting there saying, I'm still holding this market long, and everybody's talking about, here comes the bear market and the recession and or 1987 style crash. From here, I'm gonna lose my job, or I'm going to lose so much money if I don't get clear of this. And that emotional decision, even though there's great values out there, that emotional decision gets made because the market forces that hand. And I think it's possible that we could see that same process to the upside now, kind of like a mirror image of upside movement to what we saw in December at the lows. So that kind of energy around it it's not logical, it's emotional and psychological. And so I'd like to participate in that if the setup works correctly, if it offers me that trigger line.
I would almost think you might lean towards the Dow in this case because it has had relative strength. This one actually is above the 200-day moving average, so you don't have that as a hurdle. You might have a smoother, cleaner path to the upside.
It's possible, yeah. I mean, whichever setup I like. Now, the one advantage with the NASDAQ is if you get that kind of shifting from skepticism to exuberance kind of move, it's possible that you start to see the chasing in the retail investors, and the NASDAQ is kind of more of that buzzy retail side. So kind of what I was looking for, but yes, it absolutely is a possibility because, again, the financials and the energy stocks were the most disastrously capitulated and shaken out to the downside, and the NASDAQ really lacks both of those facets of the market.
So upon reading your note, your basic notion is that the bond market isn't necessarily buying into this rally. I'm going to put the chart that you did in your earlier post on the Trader Audio page so people can follow. But why don't you talk about what you're seeing in the bond market as it relates to some of the things you talked about in equities?
Yes, so I mean, the bond market is very different than the stock market because you've got fungibility in a global market landscape, and interest rates are going to connect up around the world. Stock markets can diverge heavily. The European stock market can diverge completely from the U.S. stock market, but the European bond market and the interest rates that you can get in Europe can't diverge very much because you could simply borrow from one and loan to the other. So there's just an arbitrage process that's going to lock them in step to some extent. And recently we saw the global index of sovereign debt around the world move to the point where we had the greatest total dollar amount of sovereign debt in negative yield territory. So you'd think that would be back in early to mid 2016 around Brexit when we had 70%, but we just passed it to like 73%. So we're seeing, I think Germany is now negative out to 9 years of their curve. Right, it's just, yeah, and that's going to arb back to the U.S. It's going to be awfully difficult for United States interest rates to move too much higher while they're being anchored by cross-border flows, because right now, I mean, you've got the other factor to mention in this process is the cost of currency hedging. So the forward contracts on currencies, because if you're an institution and you see a huge differential between German rates on the 7-year and U.S. rates on the 7-year, you can just borrow in Germany and loan to the U.S. But you've also got to control for the currency risk because you're doing a currency conversion in that process. So I would imagine at this point that the currency forward hedging contracts are actually probably pretty expensive because of the Brexit process, but they're not as bad with Japan, and Japan's sitting in a similar situation with negative interest rates. So either way, the bond market is not able really to show that risk-on reflection of what's happening in U.S. equities because, again, it's tied to a global interest rate complex through the arbitrage process. So I don't think it's necessarily the statement that the bond market is seeing a recession coming in the United States. However, it certainly is seeing a tougher road ahead for the global economy as a whole, and the United States economy does not exist in a vacuum, despite the efforts of individuals to make that so. It is tied into many different processes around the world, and it would be difficult for the U.S. to continue to take off if the rest of the world moves into recession. So it's a factor to keep your eye on. But I think that the real point underlying the action that we're seeing right now in the bond market. It's about arbitrage to a significantly negative yielding bond complex around the world.
And you're still short the bonds, right? The 30-year?
Yes. Yes, I am.
Okay, so at this point, you have no reason to even think about taking that off right now.
Yeah, I've seen a favorable response, and I'm still up. I got short early January. And, it's been a position that's bothered me, but as I said, I'm not sure that we've seen cycle end. So, I've kept the investment side of my account in the markets on the long side in equities in a non-trading account, and I've kept the bond short on, both kind of for the same reason and rolling at contract inflections. But yeah, I mean, it could be something that I throw out, and it could be something that really ends up not ever making me too much money, despite how far in the money I was back in September and early October. But, it's been a position where I've just kind of married myself to it a little bit on a larger time frame. So.
All right, fair enough. You had touched on Brexit earlier. You wanted to circle back on that one. We did have a question earlier. Just now, I was a little unclear on the listener question, but it. Well, while I'm fumbling around, you got it. You got it.
Yeah, I got the gist of it. I mean,
okay.
Really, I don't know if it's so much a question as just pointing out, that there's an amplification in tension right now, and there's a lot of statements that went back and forth, particularly out of an EU official who basically suggested, that there's no way that this is going to be renegotiated in any way, and we're headed toward a no-deal exit for the UK. And that's kind of the big boogeyman here, is the idea that there's not really an agreement that's ever signed between the two, and I consider it like, if what we're going through is the process of somebody getting out of a car, this is the car not stopping.
Yeah.
And somebody just jumping out on the freeway. That would be the impact on the UK if there's no kind of deal struck, there's not a Brexit agreement, a negotiation that successfully results in an arrangement. But, I think like they've got a great opportunity to do a lot of tough talk here, because when you get to this stage of a negotiation, people are going to posture on both sides that they don't need the deal, because that gives them more leverage, obviously, if the other side thinks that they've got, the ability to just walk away from the table. But the EU is uniquely positioned that way right now. It's really easy for them to make a lot of inflammatory rhetoric jump out there, because they have something backing it up. There's a logic there that probably allows people in the UK to start really believing that the EU would just walk away from the table and let this be a no-deal exit, because you got to remember, the EU's thoughts aren't just about the UK. They're about Italy. They're about Portugal. What about the next downturn? If we move into a recession, all of these things happen during countercyclical periods. The next time we're in an economic slump, you're going to see big problems in Southern Europe, huge problems. It's going to blow up again. Those spreads are going to blow out. And, Italy's vulnerable right now at the best point in the cycle. If you look over last year, so I think that they're preparing for a rhetorical stance that's a deterrence factor for people leaving, because if the UK has a really bad time in this process, then it sours support for an Italian exit or a Portuguese exit or a Spanish exit or anybody else who might be thinking about it when times are tough and you're not able to do currency easing. I mean, that's the big point here, is when times are tough, you need to be able to stimulate your economy through some monetary means. But if Germany's doing okay and Italy's having a really rough time, suddenly Italy can't find any way to support itself except for breaking the deficit agreement for being in the EU, by doing fiscal stimulus, because it can't do monetary stimulus because it's on the euro. So there's this fundamental problem with the underlying structure that is the Eurozone that always comes into play when we get into these situations, and you see it when the spreads blow out and the CDS blow out. Italian rates diverge drastically from German because their debt is seen as suddenly vulnerable to a default, or at least a currency default. So, they're setting up, I think, a framework for deterrence here by making this really tough on the UK. And that's a big part of this negotiation that needs to be appreciated. But it also makes it plausible. So when they say, you know what, we're done with this. We're not going to give you any more concessions. We're not going to give you anything. Take it or leave it. Here's the deal, and it's a bad deal for you. When they say that, it makes it really difficult on the UK because even though at the end of the day, if we start getting toward the deadline, most likely EU officials are not going to want this to be a no-deal exit because there's huge business ties between the two. A lot of people in the UK are going to suffer. Probably a lot of people that fund a lot of campaigns, are going to suffer if that happens. Nobody really wants that to happen. But the negotiating leverage is all with the EU because they can plausibly suggest that, this is the only option they got. There's nothing I can do. I'm sorry. You're just going to have to take it or leave it because my hands are tied because we got to worry about, other people exiting, so we can't give you a sweet deal. And so that's probably going to turn things sharply against the UK in terms of the negotiation process. But again, I think it's posturing. I think at the end of the day, you're not going to get a no-deal exit. The market's going to get shaky around the idea that could happen because that's the bad outcome. But I think it's unlikely. It's probably more just a really advantageous negotiating position that they have right now, and you're seeing that on display.
Let's just say for a second that there was a really bad deal. Maybe not as bad as you're talking, but a bad deal nonetheless. Would it be even worse for, say, like Ireland in this case?
I mean, obviously their economy is more, if it's the U.S. we're talking about, it'd be bad for Canada. So, I suppose.
Well, I think you could be a little more opportunistic with shorts if you're going to play that way, using Ireland exposure because there's probably more bang for your buck on the downside, no?
Could be, but the point you made is probably something that's relatively baked in.
Oh, okay.
I mean,
so there wouldn't be any surprises, is what you're saying.
I'm not sure that. I think the surprise, it's a lot like if you remember our talk about this is a while back, I think 2017 in May. Do you remember the French elections?
Yeah. Mm-hmm.
Yeah, that was what really sent the euro higher, and there was a trade there that was really important, and we outlined. Gavin and I talked about it quite a bit, which was essentially the idea that Le Pen was going to win, and it would be part of this sort of nationalist revolution in politics everywhere, and that could cause a French exit. And so people had to hedge for it. You've got huge managers, huge amounts of money that have to stay away from France at that point, and have to stay away from the euro coming into that, not because they think Le Pen's going to win, but because they have to assign maybe a 15% chance to that. But it's such a catastrophic event if it happens, and France leaves the eurozone, and you've got, trillions of dollars of debt that suddenly gets repriced to a super weak franc, and money shoots over into Germany, and everything gets completely out of balance. That it was just a chaotic possibility that was low probability. So what that sets up is a trade where the moment when that doesn't happen, it's going to take time for the exposure to rebuild to France. So it's an easy trade to take on the other side, to get long the euro, to get long French equities, etc., once the bad thing doesn't happen because they've got this scary thing. I think this is like a miniature version of that, which is probably at the end of the day, there's not going to be a no-deal exit. But since the EU has this negotiating framework, they're able to really amplify this rhetoric, and it forces kind of the same position, because if you're a fund manager and you're overly exposed to the pound and UK equities into that point, and it ends up being a no-deal exit, you lose your job. Right? So you're not keeping that job in that situation, given that somebody could just point to a newspaper and say, look, they said this was going to happen. How did you stay in that position? So you've got a lot of people who maybe realize it's not going to be a no-deal exit, but they still can't expose themselves. And they may be anchored at benchmarks that assume a certain percentage of UK exposure. So they'll have to be out in front of it, and they'll have to be in after it. And it probably means that the actual moment when we get either an extension, which may be the most obvious possibility, you get that rebuilding of exposure right after. So March 29th is the big deadline. Maybe late March we see, just huge hedging come in. And it offers an opportunity to kind of just, wait till March 29th and buy exposure alongside on the UK.
Now, this is a listener question regarding Brexit. What are your thoughts that in the end there will be a second referendum and therefore a collective never mind?
Yeah, it's such an interesting possibility. It just seems like there has been... they're never going to admit to that possibility along the way. It seems like I feel like we've gone past the point of no return on that one, honestly, even though probably if that vote were redone, it would have a different result. That's my gut feeling. I mean, this has been a nightmare process, and maybe it's kind of like, oh, you look at a room, you don't like being in that room, but there's a door over there, and this has offered them a chance to look through that door and see it's an even worse room. And so maybe they thought it was great to be out of the room they didn't like, but now they see the only exit, and it's not a good place to be. They've gotten the chance to appraise that. So I think that the referendum would go the other way, but I feel like it would damage credibility in all sorts of levels, and I'm not sure whether that's going to end up ever being an option.
See, I always thought that it was the longer this goes, it's a greater possibility just attrition setting in.
No, I mean, there is that possibility. I agree with that general thought, yes.
And to me, it's like if you can envision a married couple who are going through a divorce, and it's just going longer and longer and longer, and they've been on the dating scene, and they're like, oh, nothing's working. I can't. And they meet up.
Great analogy.
And they meet up and say, well, it's the devil you know versus the devil you don't, and I'm tired of fighting this. Why don't we just get back together?
Right.
And
I got on Match.com. I had 2 dates. They were terrible. I thought that this was going to turn out to be a really fun time. It's just not working out, honey. I'll take you back.
Yeah, and you could see something like that happening in this case. I think attrition, and
I think that's a fantastic analogy.
People have short memories, and when it gets tiresome, it gets tired of fighting and the stalemate. I think it's a higher probability. If I was handicapping it, I would call it a higher probability probably than you are, just based on that type of mentality and what we kind of see in society. And plus, things change. I mean, Europe is notorious for kicking the can down the road as long as they possibly can. So I don't see why this would be much different.
In my chart book, I wrote that, I think that one of the most likely outcomes is that we're, coming up to a Brexit vote in March of the year 2029. It's just the same thing. We keep going through this process. We keep publicizing a possible outcome. There's an extension. There's details to be worked out. We could still be in the China trade war and Brexit in 10 years.
Exactly. And we're, and by
that
that
doesn't mean there'll be a second referendum. It's possible that they have the tools to just keep it in this state.
Well, maybe they'll think they just forgot. There'll be other big...
I'd like to see a second referendum. I would really prefer to see a second referendum. And then I would prefer to see the Eurozone completely remapped so that there is either the United States of Europe or there is no Eurozone. Because otherwise we're going to keep getting into these issues over and over and over again for the rest of our lives. It's just fundamentally flawed as a structure. To share a currency but not share anything on the fiscal side or an interest rate is an untenable situation. But we're just going to have a million of these situations come and go, because cycles happen. And when you're in the down part of the cycle, you're going to put in the necessary preconditions for going through this process and having popular appeal to an exit.
Selfishly, from a trader aspect, I would hope that the whole EU broke up. I think it would provide more opportunity. I mean, I don't know. You were probably around. It was probably your early days trading if you were dabbling in the currencies back then. But it seemed like a more opportunistic approach in currencies. You could really put together different strategies and different trades that were advantageous.
I'm agreeing with you. I think it's a flawed structure the way it is. I've been kind of rooting in that direction because I think they won't become the United States of Europe. There's too much history there to say that, it's essentially, even though there are national boundaries, they don't really mean anything because we have, they're essentially states. It's instead of Italy and Germany, it's Georgia and New York. It's just, that would be the matter of fact, de facto reality if they had a kind of fiscal side of their union. So the monetary union plus the fiscal union, it would be in essence the United States of Europe. And I think that there's too much history there to allow them to actually take that step. So rather than get caught halfway over the fence, just revert back to a situation where you've got a friendly group of countries trading on their own currencies so they can take their own steps in terms of monetary management of their economies during cycles. I guess that's where I am. So I agree with you. As far as a trader standpoint, as far as just any philosophical position, it just seems like that would be a more sustainable and reasonable outcome.
All right, before I let you go here, I know we do have a lot of new listeners who may not be familiar with your chart book. Why don't you let everyone know what your chart book is, what you talk about? You don't have to get into specifics, but just a ballpark, Cliff Notes version of what it actually is and where they can find it.
Okay, yeah, sure. If you look under the Investing and Trading tab at the top, it is in the category under ETF analysis called Industry Insight. And you can find all the chart books I've done over the last number of years. And, it's roughly around once a month. I skipped the December one, but it's basically once a month, maybe 11 a year. It's basically a top-down, deeper version of my ETF notes where I cover equity markets around the world. The sentiment situation is usually in there. That's one of my primary inputs. Understanding where investor sentiment is through a number of different measures. You see a good example of that in this latest edition. And generally cover commodities, different commodities, always crude, sometimes copper, usually gold. Cover currencies, particularly the yen and the euro typically. Cover China. Cover EU equities. Just basically a kind of around the world top-down look at various asset classes to get a kind of big picture view, a telescopic view of everything and see how the puzzle fits together from a very top-down perspective. And I focus on any data that I can get that demonstrates exposure levels among key participants in the market with an idea of understanding where momentum is, as well as whether or not we've seen an extreme that's vulnerable to reversing one way or the other.
And you could think of it like this. If ChartBook is your monthly outline of how you're looking at things, then your daily note would be the individual chapters on an updated basis, because you refer a lot to ChartBook back and forth, and then here's a real-time update of what I'm seeing and how it plays out. So you can really get a good snapshot of preparing how you're coming in and then how things unfold as the days progress. So I definitely highly recommend checking that out anytime he posts it. The sentiment data is always of value, and he's always good about answering questions. Hey, I don't know what the robo ratio is. Can you please explain it, where I can find it, etc. So Chart's always good about doing that, and it's a very good preparation. So I highly tout this one. And for anybody who might be listening to this now, don't know, might have missed the Trader Audio Visual, I did an example of how you can find it under that Investing and Trading page on the visual, so you can follow along. So hopefully that makes sense for everybody. Any final thoughts, Chart? Any new updated trades that you may have up your sleeve for this afternoon?
No, I mean, I outline my bias on equities. I would like to see a kind of capitulatory blow-off form. One last thing I'll say is, listening to the State of the Union, it was brought up and analyzed that, there's this pitch for the possibility of Trump being given tariff authority, and I would say, as I said to Gavin earlier, I think that has a worse likelihood of passing than a law that would give Trump unilateral control to use drones to shoot puppies. I think there is less than 1,000,000% zero chance that that law could ever be passed under any conditions. The Republicans would be against it. The Democrats would be against it. I think they'd like to take away his Chapter 232. So I think there's no way they're going to extend universal authority to put tariffs on any country he wants at any time without congressional approval.
Yeah, I find it hard to believe as well. But, throwing out there is probably some kind of posturing for something. So we shall see. All right, Brett. Well, as always, thank you so much. Very educational, and we will look out for a potential trade there in the equities. Thank you so much for joining us today.
You got it. Thanks, Jim.
All right.